Welcome back to Am I Catching a Falling Knife? Today, we're looking at a stock that's seen some serious turbulence, SNPS, or Synopsys. This company has experienced a dramatic drop, with its stock price plummeting a staggering 50% over just the last 10 days. So, the big question on everyone's mind, and on our show today, is, are we witnessing a buying opportunity, or is there more pain to come? Let's dive in and dissect what's truly happening with Synopsys. All right, let's get into the nitty-gritty of SNPS. The single most dominant market narrative currently driving Synopsys' dramatic price action is quite clear: a disappointing earnings and revenue miss, combined with a lowered full-year outlook. The company directly attributed this underperformance to the negative impact of US-China trade tensions, specifically hitting its design IP segment hard. This news, understandably, sent the stock into a significant plunge. So, what exactly does Synopsys do? In a nutshell, they're a powerhouse in the electronic design automation space. Think of them as the architects and tool makers for the semiconductor industry. They provide the sophisticated software products used to design and test integrated circuits, offer intellectual property solutions for everything from USB to Bluetooth, and even provide security testing for software vulnerabilities. They serve a wide array of industries, from electronics and automotive to medicine and energy. Now, let's quantify the impact of this narrative. It's not just about trade tensions. It's about how those tensions translate into real numbers. Here's our breakdown. First, we identified that Synopsys' design IP segment, which for our analysis we're interpreting as a substantial portion of their license and maintenance revenue segments, makes up about 82% of their total revenue. Second, China is a significant market for Synopsys, accounting for about 16.15% of their total revenue. You combine these two, we estimate that about 13.26% of Synopsys' total revenue is directly exposed to these trade tensions within the affected segment. Given the severity of the significant stock plunge described in the narrative, we've made a pretty strong assumption: an 85% reduction in that specific portion of revenue for the quarter. When you do the math, this translates to an estimated 11.27% reduction in Synopsys' total quarterly revenue. Based on their latest annual revenue of $5.84 billion, that's roughly a $164.5 million hit to quarterly revenue. Applying their gross margin of about 21.72%, this revenue reduction means a $35.79 million drop in gross profit. Assuming operating expenses stay relatively fixed in the short term, this directly impacts their earnings. Using their free cash flow as a proxy for quarterly earnings, we estimate that this narrative, specifically the US-China trade tension impact on the design IP segment, could lead to about a 9.48% reduction in quarterly earnings. Now, I have to be transparent here. Our confidence in this precise percentage has a wide interval, ranging from a 5.5% to a 13.5% earnings hit. This wide range is because we're making some key assumptions about the exact scope of the design IP segment and the specific magnitude of that 85% revenue decline. It's a best estimate to capture the narrative severity. So, what does this mean for valuation? SNPS is currently trading around $387.78. When we run a discounted cash flow, our base case, without considering the specific earnings hit, gives us a fair value of about $253.53. However, when we adjust our model for that estimated 9.48% earnings impact from the trade tensions, our narrative-adjusted DCF value drops to approximately $219.30. For another perspective, a PEG-based fair value comes in even lower, around $186.95. The current price is clearly quite a bit higher than even our most optimistic fair value, let alone the one adjusted for the very narrative currently driving the stock. Looking at potential entry points, if you're watching Synopsys, some custom buy levels we've identified that might pique your interest are around $290, then $250, and a deeper level at $215. These are areas to keep an eye on if the stock continues its downward trajectory. So, to wrap things up, Synopsys has taken a significant hit, primarily driven by US-China trade tensions impacting its crucial design IP segment. Our analysis suggests this narrative could translate to roughly a 9.48% reduction in quarterly earnings, leading to a narrative-adjusted fair value around $219.30. The current market price of nearly $388 is still well above this, even after the recent sharp decline. Remember, folks, this is not financial advice, and these are my interpretations and calculations based on the provided data. Always do your own thorough research and consult with a financial professional before making any investment decisions. Stay smart out there, and I'll catch you next time on Am I Catching a Falling Knife? This is Dave, signing off.